Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, whether you're active, passive, somewhere in the middle, or maybe just you've been working in the industry for years, maybe decades, well, the Gray Report is the one YouTube show and podcast that we've designed specifically for you to keep you up to date with all of the new information, trends, research going on in the multifamily industry. We're covering the multifamily industry, but also housing and the general macro economy, so you can have the best information to make some really good and well-informed decisions. As is every week, a lot of movement in the markets, in the news, with the multifamily industry, in the macro economy. We've got reports from Moody's. We're looking at some data from the U.S. Census Bureau, the Federal Reserve Bank of the United States, MSCI, RealPage, Berkadia, Apartment List. We've got a jam-packed episode for you today, so you want to stick around the entire time. Make sure you're subscribed. Give us a like so you can get every single one of these videos and updates. All right, let's get into it. All right, everyone, welcome back to the Gray Report. I'm joined again, as I am every week, with my co-host, Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital, guy who's kind of an engineer of the Gray Report. So if you're getting the newsletter coming out weekly, it's the best multifamily newsletter in the industry, Matt. That's what we hear from every single subscriber, just about. I mean, a lot of great accolades. It's not just, hey, this is what we did last week, but this is what you need to know. And it's mostly read by industry insiders, owners, and operators. Guys are doing thousands of deals a year, thousands of units a year. Those are the people who are actually paying attention to our newsletter. When I see who's reading it, it's the people who are doing this every single day. And so this is a tool for industry insiders. So if you are an industry insider or you want to be, you're trying to get that knowledge up, we're so humbled that you're using not only the YouTube show and channel, but also the newsletter as a great resource and tool to do that. So you can sign up for the newsletter, graycapitalllc.com/newsletter. Again, it comes out every single week, 8:30 a.m. Eastern time. Matt, a lot of these articles were featured on the newsletter this week.
Oh, yeah.
A lot more on the newsletter. But what was your general sense of the mood for the market? How are you feeling? How are you feeling today? It's a Thursday. How are you feeling this week?
This is what I titled the newsletter was that cracks are starting to form in apartment prices, and they're not bad cracks, I don't think.
Okay.
You know, we're actually in the hole. The cracks we're seeing light through the end of the tunnel, maybe some softening of prices and something that's really attractive for buyers and investors. Because the other sign that I got, the other upshot really, was that rent growth is trending positive. We're maybe approaching pre-pandemic normal when it comes to like vacancy and apartment demand, but we're definitely moved out of the like seasonality hump of the winter.
Yeah.
We're moving into the renting season, and we're not seeing sustained rent declines and stuff. So,
well, and that tracks with still elevated recession in the economy, still humming along, and very low unemployment rates and very few job losses, and maybe we've been talking about some potential pent-up demand. People are just putting off some of those big decisions from last year.
Yeah.
Maybe people are kind of bored and tired and they're ready to make some of those decisions. But, I mean, typically as inflation stays elevated, rent growth stays elevated also. Not that they're not going to always move in lockstep, but it makes sense with the labor market being so tight and entering a little bit of a wage price spiral potentially, which could be a little bit unnerving. But
well, that's the other angle that I noticed. It's been about a week out since the release of last month's minutes from the FOMC meeting, and they want us to be pretty scared of what they, and by they I mean the Fed, wants us, I think, to be pretty scared of what they could do to the economy in terms of raising up interest rates to really cool off the economy. So they don't want us to forget it, I don't think.
Well, if we have to remember, I mean, monetary policy can take a long time to get through the system, and it has not yet been like 12 months since they started raising rates.
And that's a really good point. And I'm not sure if I was definitely thinking about that as I wrote it. It's like, well, they're thinking about all this bad stuff, but like there's a lagging indicator they really haven't addressed.
Yeah.
And I'm hoping that they're thinking about that, because a lot of the writings and a lot of the research that comes out of the Fed acknowledges, at least, at the very least, like home prices and rents are about a year off from interest rate hikes. So, from the CPI. So,
yeah. So I think we've got not everything has unfolded just yet. We're gonna have a lot more things happen over the next couple of months and probably the next 6 to 8 months. And so we're not out of the woods yet, but I agree. I think that maybe some of the cracks are getting wider, but maybe we can see some of the light at the end of the crack tunnel or whatever it may be. because even if, again, like in a touring property yesterday. And right now, on acquisitions, it's like, okay, maybe the prices are getting closer, but there's still this transaction risk of I'm going to go under contract today with interest rates being where they are, but then in 60, 90 days when I close, they could completely move. And it's not even the Fed funds rate; it's the volatility in the bond market in general, and whether it's the 10-year moving or typically it's the 10-year when you're talking about mortgage rates. We've moved 50 basis points from a couple weeks ago.
Yeah.
We did 3 deals last year, and in the middle of it, the 10-year moved 100 basis points. It can completely wreck a deal. You have to have tough conversations, and a lot of buyers don't want to put themselves into a situation where they're spending a lot of money and the deal can turn. But even if they were open to taking on that type of risk, the deals just aren't penciling with the debt that you'd have to put on the property and the prices that sellers are still. I don't know how many times this week and in the last week. Talking to sellers or through brokers or whatever, still looking at these people who have product that is not the sexiest deal, and they're still going for 4 caps.
Well, that's what I said yesterday when Jay came back. Jay does a lot of our acquisitions. I said, was it another 2023 sale for 2022 prices? Because that's what it's like. It's like we're at the early half of 2022. People just haven't really caught on.
Yeah, and I think that I think you're right. I think some people, there's some FOMO also. Some people who are considering selling, and they're like, prices are great, I could sell, and then the market started shifting, and they're like, oh, okay, I need to sell. Okay, just throw it out there. It doesn't hurt. If no one bites, then nobody bites. But that's the thing. I don't know how many people are biting right now.
So I think one of the big motivators, yes, it's like, will it work? Can we wait 1 or 2 years? Can we make it work with mezzanine debt, whatever, for distressed properties? That may be one issue. But the another is this fear that if I sell tomorrow, is it going to be a lower price? Right now they're thinking maybe it'll stay the same. Maybe I can ride this out. But how much are we going to crank up the fear? And some of these numbers.
A broker yesterday. Yeah, they're like, sell now or sell for a less price in a year. So now if you have it really only becomes a tough decision if you have a short time horizon. If you got a year, 2 years, you have some hard decisions that you're going to have to make, and you're going to have to take some risk, going one direction or the other. But if you've got 3 years, 5, 7 to 10, you have a lot more options. Time is everyone. And today, if you have time, you have a lot more options. And that is something that has been a cornerstone of our investment strategy, is to use time to our advantage and not have time working against us. Because there's a lot of different ways you can invest in a lot of different things where you can have the right direction but mess up the timing. And if time is a major variable, we're not good at planning. We're not good at timing. Just humans in general. And if you are, do it.
Yeah.
But I learned quite a few years ago that that's not something that I'm an expert in, and I think.
Yeah. And there's so many times where people have the right idea. They just didn't have the right idea at the right time.
Yeah.
And you can really screw yourself.
Yeah. It's a great property to buy. Absolutely. It's a great piece of real estate. There's growth, but you have to sell in a year, and that growth happens in 2 years.
Yeah.
You've missed out.
Yeah.
The recession happened in your short time frame. Well, if you had time, it wouldn't matter. It'd be a blip. You get through it.
Yeah.
But if you need everything to line up and happen in a certain sequence or order, it becomes harder and harder and harder.
Yeah.
Let's move, Matt. Let's get into this.
Totally.
We got a lot of reports, a lot of data. We've gone through our, just little anecdotes here and there. But let's jump into this apartment list.
All right. Yes.
Let's jump in this apartment list report right here. This first thing that I'm missing, Matt. And as you mentioned here on the notes, we've got a interview coming up with Apartment List. So we're going to be able to dig into a lot more details. But for this report, because we feature them all the time, and that's why we wanted to have them on the show. What's going on?
Yeah.
Welcome to March.
So quick update here again. This is the second of 3 teasers that I'll make for an upcoming Gray Report episode. Spencer's going to be speaking with the head of research at Apartment List, Igor Popov, and talking about this report and some other recent reports in Apartment List. So that being said, I do want to fly through this report and call out a couple of figures before they deal with it in detail later. Year-over-year rent growth is 3%, and that compares roughly, it's a little bit above the average from 2018 to 2019, which was 2.8%. So we're about normal there. Month-over-month rent growth is 0.3%, actually after 5 months of negative rent growth. And if you expand that 0.3% out, we get what, 4.2 if we have a full year of 0.3% rent growth. So that's a good sign. Again, I take it more of as a sign we're emerging out of this seasonal slump that we had and this kind of reaction to the high rent growth of 2021 and 2022. I think it's always too early, it seems like, to call a trend, but I don't think so here. Rent growth has been getting less and less negative since November, and now the third month into this positive trend. Really the 4th month, we're actually finally seeing positive rent growth above negative instead of simply less negative rent growth. And then one small item before moving on, Apartment List's interactive map of rent growth in different markets. I was drawn into it weirdly this week more than others.
This one, Matt?
No, it's actual map, not the one that confuses me.
we can ask Igor about that.
Yes.
Maybe we should.
It has some artistic aesthetic value. I can't understand it yet. But they have a map of total rent growth of a market since the start of the pandemic, and then they have the month over month, and then the year over year. On this map, it's a little interactive map at the bottom of the Apartment List article. At first, I was really I really loved it because you could see how much each market grew since the beginning of the pandemic. Well, once we were well into the pandemic, I was like, all right, maybe we need to. I'm back into it. I'm back into it now because we have a clear stratification of how things were moving 2 years ago, 1 year ago, 1 month ago, and you can see a real story emerge in the long-term, medium-term, and short-term performance of some of these markets. So just to take one example, and then I'll get out of your way. Chicago enjoyed a healthy 5.1% yearly rent growth and a 0.9 monthly rent growth that's still among one of the strongest. But since the pandemic, it has only had 6.1% rent growth, far less than like the 20+ rent growth seen in other markets since the pandemic. So that story for Chicago is a similar, you can see kind of similar numbers for Boston, where you can notice some of these markets that didn't grow at all during the pandemic, now they're kind of bouncing back. But other ones really performed very strongly during the pandemic, and now they're not doing so well. But you get that story in this map, whereas before maybe it was a little bit more overlapping. So yeah. I appreciated it. I dove into it, and you can really zoom in and get in a lot of these submarkets. It's really nice, the level of information that Apartment List just openly provides. I even started clicking into their individual market reports, which is really great. There's like graphs for everything. They've got a really good machine.
Yeah, I know they really stay on top of that. That's I'm excited to have Igor on and really kind of get into not only just the methodology, just how they go about it and how they put the information together.
Yeah.
And you learn more about it as we talk about it just about on a weekly basis.
Yeah.
Here in the Gray Report. It's great.
So, That's a teaser. Again, this is all I'll say on this report, except to give an additional teaser to tune in into an exciting guest appearance by the head of research at Apartment List, Igor Popov. Stay tuned. You're not going to want to miss it.
Stay tuned, everybody. I'm sure there'll be a link in the comments, or a little like one of those pop-up little things.
Oh yeah, right, yeah. I'll add a little annotation or whatever. Yeah,
or it can pop at the end. We can make sure that video pops up.
Yeah.
Might as well. Okay, Matt. Let's just switch to property values and the Fed. We got a little bit we got minutes that came out from the Federal Reserve. We were talking about it last week. They hadn't come out just yet. We were anticipating them come out. So FMOC, Federal Open Market.
Last week they released these. We're about a week late, but they're still very much jibe with a lot of the discussions that were happening. It was almost like they released these minutes, and then there were a bunch of different sources and reports that were kind of covering them and breaking them down and expanding on some of the ideas specifically that they rose. So I think that the headlines in some of those reaction articles were focused on maybe one passage specifically, which I'll quote here. It says, "The staff provided an update on its assessment of the stability of the financial system and, on balance, characterized the financial vulnerabilities of the U.S. financial system as moderate. The staff judged that asset valuation pressures remained notable. In particular, the staff noted that measures of valuations in both residential and commercial property markets remained high, and that the potential for large declines in property prices remained greater than usual." Later, the notes mentioned vulnerabilities in the financial system associated with higher interest rates, including the elevated valuations for some categories of assets, particularly in the CRE sector. I think this is their red flag, and they're using it. They're almost couching it in this word that's elevated. Oh, they were already high already, and we're just going to knock them back down. At least they don't characterize the effect of higher interest rates as returning to normal, but it's a small comfort to CRE owners that the Fed's notes describe falling valuations as a vulnerability. Yeah. I think this is if you read it in a certain way, it's a way of them saying, like, get ready. We could really
and Jay Powell has made comments, all the way back to last summer of talk of basically saying the real there was should be some pain in real estate based on where it was, and even said, like, hey, if you're looking to buy a house right now, maybe I'd wait a little bit. I think prices might be lower. So they haven't stated that knocking the housing market down a little bit is part of their goals, but I think that is part of that, of just one area of the economy that's really seen some heat over the last couple of years. So it's definitely time to be cautious, especially in those markets that have seen those really crazy run-ups. And
another thing that was released, and we'll get to it in just a second, was some of their stress tests. But at least in the minutes of their meeting, more than the stress tests, they really talk about this inflation danger, and they don't want inflation to become unanchored. They don't want it to be untethered or unmoored from the steady hand of our betters at the Federal Reserve.
Exactly.
Here's what I think, and this is, and you'll have to forgive me for this reference I'm about to make here. What I can only hope is that the Federal Reserve, at the same time that it's thinking about prices like unanchored boats swirling into a vortex, maybe the Fed also thinks about the lagging effects of interest rate increases. So some assets in some markets are going to react quickly to these interest rate hikes, and some it's going to be a long time coming. So we're talking all about these anchored.
Do you think they don't know?
I think.
I think that they're, okay, so let's say, Matt, you and I are, our knowledge is what it is. We have a YouTube show. Do we own and operate a couple, thousands of apartment units? Yes. But I'm just, look at all these fancy folks on here, really nice titles. We got a big staff of folks. You think that, like, this can't be news to them, right? Well,
I think it's a question of priorities. And they know about it, but they've got a lot of other things to worry about. And if this thing is happening too much in the future, it's easy to not really.
They've got a lot of things to worry about, but isn't this like a pretty important thing to worry about?
Well, for whatever reason, it seems like they're. I get the feeling that they don't really care as much about the threat of lowering CRE prices as much as the threat of unanchored and
for sure. Inflation. For sure, yeah.
It's like, this is what we have to do to bring it down.
Yeah,
It's
they don't
almost
care
like-
about. I mean, they don't really care about asset prices unless it starts to actually affect
Now,
their balance sheet or their mandates.
when it comes to their stress testing, I think that it's a little bit different. And they did provide some updates to their baseline and their severely adverse test scenarios. On page 21 and 22 of the PDF of the stress test, and we're going to include that link in the show description, there's the full stages, but essentially the adverse scenario is one in which a widespread recession sends employment down, interest rates down, inflation down, but asset prices down as well. Even though CRE asset devaluations would be strongest in the office and hotel sectors, all of them are expected to go down. Some nearly 40%, overall CRE, and nearly like 37% for multifamily. Really, I think that this is their worst in. And I'm not sure exactly what dictates their adverse case scenario, but it seems like, at least in this one, their adverse case is, we hiked up interest rates so much it caused a recession, and this is what's going to happen. Mm-hmm. It's almost like, hey, you want low inflation? You want low interest rates? We'll give you low everything. We'll give you low employment. We'll give you low money. and in that case, it's like, it is a real nightmare scenario, and it doesn't seem as likely as their baseline. Their baseline is almost kind of interesting because it's showing, this is what they think is going to happen. Otherwise, it wouldn't be a baseline. So with that being said, and you can see the adverse scenario is definitely like low everything. Baseline features an initial slowdown and then a gradual recovery. The unemployment rises steadily from just over 3.5% at the end of 2022 to near 5% by the first quarter of 2024, and then it goes down from there. Real GDP growth declines a little bit, is negative 3/4 by the middle of 2023, and then gets to about 2.25% by the second half of 2024, and kind of settles in from there. Inflation it steadily goes down from a little less than 3.25% to a trough of maybe 2% in the second quarter of 2024, but hovers around that area. And the 3-month Treasury rate increases from around 4% at the end of 2022, around 4.75 max in the second quarter of 2023, and then it goes to about 3% by the end of the scenario. So basically, it is, no catastrophe, but it is a tapering. It's not like they're snapping their fingers and everything's going back to normal. They also anticipate things will get a little worse, then a little better, then a little normal. So they're even seeing some ripple effects. I think that the headline for the adverse scenario, this enormous 40 or 37% asset devaluation, depending on what assets you're holding. That's really the scary headline that everyone kind of glommed onto. But
they can't not put that out there.
Yeah. And what was interesting about that is that actually that low point happens in Q4 2024. So it's not like assets would decrease.
It takes a while.
Yeah.
So. Makes sense. Yeah, makes sense. Yeah, I think the Fed is in a tough spot right now because they're not going to be able to get inflation under control at unemployment rates so low. And we just had another, jobless claims number that came out, I believe, this morning.
Yeah.
And still, it's like 190-some thousand jobless claims, which is basically nothing. A drop in the bucket. And we still have an incredibly tight labor market, and they're not going to be holding up anytime soon, and they're going to have to break some things, like the labor market and maybe part of the real estate market and some other markets to get unemployment where they and as high as to get it to that 5%.
And that leads really well, I think, to this next article from Moody's.
Yeah,
they're like, it's going to be sustained inflation. This is the regime. I didn't like the 2% commitment as the name of the title is not as accurate, I think, as talking about a new economic regime of a little bit elevated inflation and a little bit of elevated interest rates.
Yeah.
It's not going to be as comfortable as some things, but it could very well happen, and that's what Moody's is kind of arguing and saying, well, what might happen afterwards? And it's a short article, but I think that it does have like kind of crucial reminders, and it says the Fed claims to be committed to the 2% target, 2% inflation target, and And they may really mean it, although the hawkish statements are expected given the negative consequences of unanchored expectations. But the likelihood of achieving this rate anytime soon remains relatively small. In contrast, the likelihood of a new higher inflation, higher interest rate regime is growing daily. I think that the Fed officials have mythologized Volcker as this hero with all the right ideas, who stood as a stalwart, stood against the clamoring masses and chaotic inflation-mongering hordes to bring peace and order to the economy. I think they love thinking of themselves as that.
Warriors.
Why not a warrior for low inflation? And why does high inflation get to be a hawk, brave, soaring, proud, and then high interest rates, and then low interest rates has to be a dove? Hawks can beat up doves every single day. I'd always want to be the hawk. That's not fair. Well, whatever.
Yeah,
that has something to do with it, as all I'm saying. But I think that we are entering this new. It does seem likely that we're in this where both are going to be high. It's going to be a hard fought battle, and it's not going to be over anytime soon.
I don't think so. I mean, I think that if you asked most people back in 2020, 2021, if we were still having this conversation in 2023, a lot of people would be surprised. I mean, there's a whole conversation of transitory, and I think it's not there's more gray than black and white. I mean, there were some things that were transitory. Supply chain stuff like that took longer. That transit had a longer period than we thought, but it was somewhat transitory. But now we've got all this other. But the effects, inflation in general, is not as transitory, and it's really, what's your definition of transitory? What period are we talking about? What's our scope of reference? Are we within a couple years, 10 years, 100 years? A couple years in a 100-year scale is a blip. I could say that the entire high interest rate period of the mid late 70s and early 80s, it was a blip in the scope of a couple hundred years, but it certainly didn't feel transitory or a blip when you were living through that period. It was an entire era. And so are we dealing with, how long of an era are we really going to be dealing with? Is it is it a 5-year, 10-year? I don't see it. I think we're going to be in a new regime in probably 10 years, but over the next couple of years, I wouldn't be expecting sub 2% inflation, at least on like the average. I think, in the winter months, sure, non-seasonally adjusted or seasonally adjusted. But where it's going to be, before the pandemic, we weren't even, 2%, we were struggling to hit 2%. The issue was that we were growing too slow when they needed some inflation. Careful what you wish for.
I do think that, in terms of which assets are going to be doing well in this environment, and I've said this before, the high interest rates is going to make buying and selling a little harder, and it may make buying a home a little harder. But Moody's themselves talks about how higher inflation may not be a significant problem for multifamily, as demand tends to be pretty inelastic, with landlords relatively easily passing higher costs along to renters. So high inflation, we can respond to that as long as it's not stagflation.
It's the consistency. Stagflation is a problem, which we are dealing with a little bit of, I think, stagflation, as at least in a temporary period of the last quarter of rents declining as expenses have continued to rise. But as we mentioned earlier, rents should still keep going if we're in a relatively moderate inflationary environment. Still going to be a challenge to get positive NOI growth in the short term, but it's possible.
And this is just looking from past episodes. I said this last time: the interest rates were above 5%. They kept them there for a year. So that's what we may be in for. We haven't even reached whatever peak of and that's another thing I was going to mention, is a lot of the conversations recently are a lot different than they were last month. Last month it's like, okay, maybe we don't need as high of a rate hike, but now they're like, let's take it up. Maybe we need more. So maybe they're expecting.
Until we get, again, interest rates can stay high. They need the volatility is adding to the risk right now. The volatility on interest rates, once that comes into check, that will at least allow the market to start to thaw, so people can start to get deals done and start factoring in the growth over the next period. And that should hopefully align in a time where we have a better idea of what growth may look like, or if we are in a recession or entering a recession, or if we've been able to get past whatever, stick the landing or whatever kind of landing it may be. But they need a little bit more certainty. And even if there's always uncertainty in the economy, you could have the best economy. I mean, you could argue that there's a lot of great things about the economy right now. It's almost like it's too good. But even when things are, back in 2018, it's like when things seem to be doing just fine. I mean, I can't think of a year during the last bull run, which is one of the better, bull runs, that you couldn't point to a pending, looming recession.
Yeah, there's always one.
There's always one. Now, the writing has been on the wall here because we've had an inverted yield curve and a lot of other things, but I'm gonna deal with that. It's just, but like, I got to know what my debt service is going to be, and if your loan proceeds get reduced by 15%, and you lose a couple $1 million in your loan proceeds, and your interest rate increases, deals stop working, and you take so much risk in the middle of that process. You're spending money. You're making deposits that are often non-refundable. You're taking time. You may have earnest money that's non-refundable. So there's so much risk. When people understand the risk. I mean, earlier last year, people were still in denial about interest rates moving. Yeah. And even though if you knew that interest rates were going to move, no one was ready for the speed at which they move. Yeah. And again, we're seeing that again recently, whether it's the 30-year today or this last week. It's also been several weeks, the 10-year Treasury moving from about 3.5%, now we're at 4%. 50 basis point move is huge. You're trying to do a deal right now. We were doing deals last year that 10-year Treasury moved over 100 basis points. Yeah. Completely changes the deal.
Man, yeah. So, and it is interesting. Actually, there was a report. It might have been an office market report that I put in the newsletter that was like, office market's not doing so great, but at least the high interest rates will be sustained and we'll get some predictability. And there's some in predictability. You gotta convince the market a little bit that it's going to be predictable.
Exactly. It's so much just convincing the market. I also want to just putting a bookend on the Federal Reserve piece, that commercial real estate price index. And when the Federal Reserve talks about commercial real estate, a lot of times they're talking about office buildings. I mean, they're talking about the whole sector in general, but office is, if you're taking an average, I know they broke it down different asset classes. And, multifamily still was projected to take a hit, but office is where, a lot of the pain is. Let's move on to this MSCI report. Prices of U.S. commercial property tumbled in January, just what we were talking about. But this is actual, not predictions. What's already happened? Apartment tumbled. Apartment tumbled.
Apartment was down, what was it? 4.6% from a year earlier, and was down 2.8% just in 1 month. I think that's a lot. I think that this is sooner than I expected to have movement in apartment prices like this, considering, it seems like these sellers aren't budging, but some of them are. And this is a natural result. And I think that I don't know if it was a long time coming, but it is definitely a sign that at least some people are bringing their prices down. Some people need to sell.
Well, and this data, I think, is still very much lagging. And again, these are transactions that went under contract a quarter plus or more ago. They closed in December and January. They're working on a midsummer, but just I'm going to say anecdotally, it's not 4.6. It's 10 to 15. It could be 10. It could be 20 in some cases. Now there's not a ton of price discovery, but I can just tell you when we're looking at deals, we're 15, 20% below what's typically being asked. What's being asked was the price that we're trading a year ago. Yeah, and it's not like there are buyers jumping in and winning the deals that we're bidding 15, 20% under. Everyone's in a similar place as we are. No one's getting their ask right now. Yeah. So this is a little bit of lagging, which makes sense. Again, all the pricing data is behind, and some of my pricing data is also like deals that don't go through. But it's I know what the bids are and are not. Yeah. And they're not coming in at the low cap rates they were.
Yeah. So I thought that was definitely meaningful, and because apartments were such a juggernaut. Even through 2022, in the middle of 2022, I found an old article last night before as I was making the newsletter. I was like, well, people were calling the devaluation of the CRE market the minute that interest rates started rising. People saw this coming. They just didn't want to budge. No one wants to budge. But they're getting there.
Well, it reminds me, and I was thinking about this this morning on the drive in. It just the whole idea of don't fight the Fed, and real estate investors back in 2020 and 2021 were keen to say as a reason to invest is don't fight the Fed. They're lowering rates. They're telling us to buy assets, take on this debt. It's time to do it. Don't question it. Just do it.
Yeah.
Take on the debt. And now we're not listen. Now we don't want to listen to the Fed. Literally, the Fed's real estate, probably needs to be brung down a long lug, and rates are going here, and people are like, oh no, I'm still going to put a floating rate adjustable loan on it.
Yeah,
I don't believe the Fed. They're not going. They can't. There's no way they can raise them that much. It seems crazy. And even though they're communicating this is what we're going to do.
Yeah.
There's a dot plot. Here's the course, but people are like no. And now it's oh well, rates less than this now, but rates will be lower near the end of the year. The cap rates are going to come down, and I think that those things, again, this comes to timing. Those things will happen eventually. I don't think they're happening this year.
Yeah.
I could be wrong. Again, back to me not being very good at timing things, but real estate is a slow moving industry. It's a big boat. So to turn it around so quickly and get all the buyers mindset.
Yeah.
Turn to realize what they have isn't worth what it was last year.
And that's what
be told that.
Well, I was thinking about, and it's a little bit related to multifamily starts versus single family starts. There's going to be a lag indicator. There's going to be a little bit of a lag for multifamily. That's a big project.
It's huge.
But residential, for building a house, that's just one person. It's a little bit easier to stop on a dime if things aren't going really well. But that's a big machine. You may be forced to continue with a project because you've sunk so much cost and time and energy trying to get things improved, especially on the development side, and then you find yourself on the wrong side of rates. But again, if you have a long enough time period, maybe you can, figure out a way around that. Yeah. So sometimes maybe the cure for something slow moving is to give yourself more time to deal with the things that.
100%. Definitely gives you a lot more options.
Yeah,
that's for sure.
So I think that the stark numbers here for apartment values not unexpected. They're a little bit surprising. But I think that there's going to be more to come, and it's going to be an opportunity, I think, for investors and buyers. And I don't want to always put rose-colored glasses on it, because if you're holding existing assets and you're forced to sell this year, that's not great. But if you do have time on your side and you are looking for opportunities, the apartment list shows that it's not like rents are continuing to go down, and I'm sure that we'll see, as more rent reports come along, we'll see other signs of positive rent growth as we're entering into renting season. So
is it too little too late for some of these folks? Because that's good, but if you've also had your there's another study recently, I think we featured it last month or last week, of just breaking down all the increasing expenses. For insurance is the biggest one, especially if you're in the Sun Belt. If you're in Florida, insurance has just increased year over year considerably. Turn costs are way, way, way up. Payroll's up. Property taxes are up. So, when you look at actual, the increase in the rent growth, well, you're still, that's good, but it's not like you're adding to NOI. You're trying to recover from an NOI loss and a negative NOI growth because your expenses have increased so much. And then you've dealt with, let's say, a month or a couple months of negative rent growth. So you're even further behind. You're digging yourself out of the hole. And again, if you have time, you can continue to dig, and there's a good chance you're going to get there if you do the right things. But if you have a loan expiring at the end of the year, you don't have that much time to dig.
Yeah, and the more time is the more you're going to be wasting.
Yeah. So,
but a lot of this does actually blend into some of the apartment supply trends, and that was another big topic that I found this week. Multifamily permits and starts have both declined. Annualized rate of multifamily permitting essentially flat compared to December. Multifamily starts fell 5.4% from last month, and then year over year, permitting for multifamily was down 4.1%, while starts were down 8.4%. going straight to the source from the census, shows that oddly enough, construction of 2 to 4 unit apartment buildings was up 26.1%, but that only made up 58,000 units. Still a rare category on the upswing. Everything else on the downswing, especially residential units, down like 20 some odd. I'll have to look at the numbers if I have them recorded here. 40% less permits for residential than and 27.3% less starts for single family homes than last year. So yes, single family smaller and more reactive, I think, to the changing environment versus multifamily projects. I think there are plenty of reasons to explain the lower numbers of these starts. So, like, for instance, they've got to deal with labor shortages, they've got to deal with commodity prices, and still like lingering supply chains where you're kind of hitting whack-a-mole. One problem comes up and another one is resolved. But there's plenty of reasons why developers would maybe extend their timeline or whether they'd have difficulty completing some of these projects. There's like 900 or some thousand units worth of multifamily that's a backlog.
Yeah, in the process. Well, yeah, I mean, one is buying more time. Two, it's like, well, we thought we had the financing figured out, and now we don't.
Yeah.
And so again, can they kick the can down the road a little bit, thinking that conditions are going to get a little bit better? Or do they have to decide that this project isn't going to go forward right now?
Yeah, that's a real tragedy. I wonder if, and there's a little bit of variation in the predictions for how much apartment supply is going to come into the market this year. You know, some people thinking 500,000, some people thinking 400,000. Well, with 932 or 971 units in construction, yes, it's going to be elevated, but I think it's not going to come all this year. I think it's going to be bled out over the next several years.
Yeah.
And it's because I think that the problem itself, this logjam itself, is slowing things down because you are having a larger pool of construction projects that are kind of sharing the resources of what used to be a smaller pool, making all of them maybe a little bit longer.
Yeah, could be. And you know, but if the labor market tightens up, well, if it loosens up and people are still want to build, maybe that's a good thing, but they all turn off at the same time.
Yeah. That was another headline. Is there was like hundreds of thousands of jobs that would be needed to really ramp this construction up. People just aren't there, I don't think.
Yeah, it's tough. It is tough. Well, let's Berkatti's got a little report here, man.
Yeah. This flows really smoothly because we're trying to predict how long things are going to take. Is going to be key to determining when this supply enters the market. And one thing I'll note here is this issue of supply. And I've seen one of the articles that I kept coming across this week was this Wall Street Journal headline that it was apartment rents fall as crush of new supply hits the market. I think it could be true in some markets. I think it is a market by market phenomenon, but I'll deal with that in just a second here. The Berkatti article is not necessarily a forecast of future apartment construction as much as it is a record of previous and current construction timelines. Timelines aren't as bad now as they were in 2021, but they're definitely majorly longer before, almost 5 months longer than pre-pandemic.
Wow. I mean, that's considerable.
Yeah. It's really, it is really not shocking, but it's considerable.
True.
And it extends, it should extend some people's forecasting of how much supply is in the market. Market by market phenomenon, I think, is it would be impossible for developers to say, okay, we are going to build units equally in all markets across the country. That's just not how they think. I don't think that's really what they're interested in. It wouldn't even be necessarily a good idea either, because it's one person's not going to know. Yeah, and that's one of the keys. And I can think even
market knows, sort of
at some level. Even Berkatti kind of
market is better at than the one guy.
Exactly. We can't buy tower. Fiat. Yeah. And that's what I wanted to know here is developers, they're going to pick the ones where they think demand is going to be high. Maybe they'll get it right. Maybe they get it wrong. But as the past few years have gone by, that demand has been in the Sun Belt. Maybe new supply enters these markets and drives down demand. Then they find other markets to build. But they are, kind of reacting to these things, and it's not like not under an obligation, but it's under profit motive, and that's where they think they're making kind of a bet. Yeah. It's a very, very, very educated bet, but they're taking on a little bit of risk.
Well, and it's and everyone's taking not everyone, but many parties taking the same or similar bets.
Yes.
And they're just and it's the right idea. Again, you're right, the demand's there. But there's only so much demand. If you oversupply it, you're not necessarily going to destroy demand, but there's not. And you can create some demand. Maybe you've got these new places, and maybe it attracts some new residents because you got the coolest new building, and maybe someone decides to move from outside they're in the suburbs or wherever it does attract them. But really, the demand is what the demand is. The demand is driven really more by jobs rather than supply. But people are saying, okay, there's X demand. My 200-unit apartment complex, it's going to be easily to absorb, because there's all this demand. There's an extra 1,000 units of absorption that's happening. Well, but now there's not just 5 other developers that are doing 200 units to meet that 1,000 units of extra absorption, but there's 20. And so now all of a sudden you've got, negative 1,000 units of absorption.
Yeah.
No one was wrong. Maybe you just can't all be right. And it's going to take longer.
And that's where it is time
to absorb.
Yeah. And you can wait it out. And I think you mentioned this before. It's like, well, one of the markets in here, and this is implicitly, they make this argument that people are betting on the same markets. 23% of all new apartment supply is going into 5 markets. Yeah. One of those markets is Phoenix. Hasn't been doing great when it comes to rent growth. People are still building. 12% of existing supply is under construction. I'm sorry. The apartments under construction
inventory change
represent 12% of existing.
Yeah, there's 46,000 units under construction, representing a 12% change to the inventory. That is I haven't seen it that high in Phoenix recently, so this is a relatively new number. People are talking about Phoenix. It's a great market. It's got a ton of demand, but again, it's a situation and scenario we just described. Everyone got excited about the demand story.
Yeah.
And the demand, it still has an incredible amount of demand, but just the supply can exceed demand. And then it's going to get turned off, and then demand's going to exceed supply again. And so you have demand oscillating around this line of supply going in and out. So.
And then the other markets.
These are all markets with a ton of demand, except, all of these markets have a ton of demand.
New York is interesting.
New York's out on an island.
Yeah, because it's so big.
Literally.
It's so big that it gets on this list because of just the sheer size of it. But all the other ones are these Sunbelt hotspots.
Exactly.
Austin, Dallas, and Atlanta, and they're all building a lot. And it all could be some of these projects that represent this 14.6% of existing supply in Austin. Some of these projects were probably started in 2020 or 2021, when at least what people were like, oh yeah, the Sunbelt, and it was a great idea then. But now
I'll give you an example. The building that right next to our old office, right downtown Indy.
Oh yeah,
and they're still working on that.
Oh man,
they're still working on that. And that was, they were really getting started mid 2020. Mm-hmm. It's 2023.
Man,
they're not done.
Yeah,
they're getting close, but it's not delivered.
Do you want to scroll up to that same report? They have the specific amount of months, that first bar graph here, average construction timeline. So pre-2020 was 15 months it took to make a low-rise building. About 20 months for mid-rise, and about, let's say, 24 months for a high-rise. And the peak was a little bit higher, but currently now we have a little over 30 months for a high-rise, about 26 or 27 months for mid-rise, and about 23 months for a low-rise building.
Sounds about right.
And yeah, it really is. It doesn't seem like, but those months are adding up, and it could get a little bit worse. It has. What's interesting is it's gotten worse from last year. This first quarter in 2023 supposedly has these timelines longer than they were last year. Yeah. So who's to know? Who's to know?
Let's talk to some more developers.
Well, that's another thing. Well, and that's what I was going to say. Is like these developers are taking on a lot of risk, and I'm sure they've got a lot of very smart people there that are looking at these timelines and
some
looking
of these developers have just been making hand over fist the last couple of years too. Yeah. So it's like they're like, all right, take a hit on one. It's all good. Everyone's in a different spot, but it's fascinating. Matt, this is an insightful episode of the Gray Report. Again, if someone's not signed up for the Gray Report newsletter, you can do graycapitalllc.com/newsletter. You're going to be way more informed than even just listening to the podcast. All these articles, way more insights, all kinds of market information. So hop on over, sign up, and if you're watching the video at this point, might as well subscribe, give us a like, or a dislike, although that would not be as good. I would prefer the like, and then a comment. Of being, again, just let us know what you think. We appreciate it. We read them.
Last week there was one that disagreed about crime as a factor for apartment demand. That's fine. I'll take that.
I read that one too.
I may disagree. I think it's maybe more of a sub-market and neighborhood thing than characterizing a whole market, but...
And I think we were saying that because we were talking about Minneapolis and saying that there had to be something more than just the crime.
Yeah.
I don't think we're saying that it wasn't a factor, because it obviously was.
I agree.
In the policies and all... Yeah, definitely crime and riots and unrest and protests, like just definitely. But it's such an extreme, such an exodus that is there something else going on?
Yeah.
I think that's our only point.
Yep.
All right, everyone. Hope to see you on the next episode of the Gray Report. Stick around and go to graycapitalllc.com if you're an accredited investor to learn more about one of our upcoming investment opportunities. Who knows? We may have one. Someday. We just closed on a deal, so all's good. All right, everybody. Have a good one. See you next week.